Good morning all. Thank you for joining us on today's question and answer session. I do hope you're all keeping safe and well. First of all, before we get started, just a little bit of housekeeping. We're all still working remotely, so we do apologise in advance for any unplanned disturbances. I'm having some new windows and doors fitted today, so it is a little bit noisy, although I have asked them to hold off the drilling for the next half hour. Just so that you know, you are all on mute and your cameras are switched off, so you can see us, but we can't see you. However, this is designed as a question and answer session. So if you do wish to ask a question, please either raise your hand using the icon or type your question into the Q&A box at the bottom of the screen. We will try and answer them all if the webinar, on the webinar if time allows, but if not, we will follow up after today's webinar with you. So don't worry, we will get back to you. The last webinar we did was on responsible investing, which is a topic very close to my heart, and it introduced the concept of how we can invest money to use as a force for good and to stimulate change. The feedback from this session was excellent. So if you missed it, all the recordings from previous webinars are going onto our new YouTube channel. So please do take a look on there, and you can find us by searching Oakmere Wealth. Now, I do want to introduce you to Louise Gilbody. Let me just see if I can get her video to start. Are you there, Louise?
Yep, I'm here.
Here she is. So here's Louise. So Louise Gilbody is our operations manager here at Oakmere. Louise joined us in April. So she's had a really interesting start to her new role with us all being in lockdown. She has, however, risen to the challenge and is a huge asset to the team. So Louise has been in the background on all the webinars that we've done so far and has been responsible for pulling them all together. So thank you, Louise. Sure. Now, because of the work that I've got going on here at home today, if it does get too noisy, I'm going to hand over to Louise to finish the interview with Darren. So we thought it was a good idea to introduce you to you all first. So now on to today's session. Darren, if you're there, if you can start your video, please. We're very lucky to have Darren Johnson with us today from St James's Place. Darren Johnson is Head of Engagement with our investment consultancy team based in Cirencester. He joined the industry in 2001 and St James's Place in 2007 and has responsibility for all face-to-face contact between the investment division, St James's Place partners and clients. He describes the job of his team as taking technical market information and translating it into something interesting and relatable to investors. Outside of work, Darren is married with 2 children, aged 13 and 10, and spends his weekend taking the family all around the country watching Cheltenham Town Football Club. He's also Vice Chair of Cheltenham Town Ladies. So the aim of today's session is to answer some of the questions that you as clients are asking or maybe want to ask but haven't done so yet. And we're very fortunate to have access to Darren who can answer some of these for us. So the format is going to be that Darren's going to give us a very quick market update first of all, and then I'm going to put questions to him. So as I say, if you do want to interject or you want to ask a question, then please do put this in the Q&A box or in the chat facility, and we'll put these to Darren while we've got him live on air. So Darren, over to you.
Thank you, Carla, and thank you for the introduction. I'm just going to share my screen before I carry on. I did have a little chuckle to myself that the photo you used on the holding screen was from February, which feels like about 10 years ago, but huge difference between pre-lockdown and post-lockdown, Darren. Are you seeing that slide? Can you just give me a thumbs up on that slide? Yeah, brilliant. Right, so I'm just going to spend the first sort of 5-10 minutes shaping how we see investing as a concept long-term, and then we'll deal with what's going on now in the Q&A. So it's not that I'm avoiding the health crisis or economic stuff, it's that by framing how we look at long-term investing, it will help shape what we say about the short term that fits into our long-term view. So I use this quote from Benjamin Graham for a long time, and it's actually more relevant today than it's ever been. Successful investing is about managing risk and not avoiding it. I think understandably 3 months ago, everyone wanted to avoid as much risk as they can, but unfortunately cash rates in this country are down to 0.1% per annum, which means that with inflation is now officially 0.5. So any money that's left in the bank for a significant period of time, we'll almost see a guaranteed inflationary loss at the current rates. And therefore, investment to us, your bare minimum should be to try and make an inflationary return, and at least keep your money at the value that it currently is, rather than being eroded away in an inflationary manner. So managing risk has always been the case, but actually in this market environment, avoiding risk is almost guaranteeing a poor outcome, given where we are and where your risk-free money would be. We've also been through a period where I'd love to be able to, when I'm in a room, I love to get people to put their hands up and contribute to these kind of things and be as interactive as possible. So bear with me on this one, but I'm sure that there'll be some people on this call who maybe feel they look at their valuation a bit too often, or maybe and feel various emotions when they do so. And generally, your emotions attached to your investment will be dictated by whether that money has gone up or down since the last time you looked at it. Now, that is a sweeping generalization, but that is just the way the human mind works. If your money is up, you'll probably feel thrilled and excited, and you'll probably think you're the best investor in the world and you want to buy more. When your money goes down, you feel fear, desperation, and panic, and you probably feel like you've made a massive mistake and you feel like you should sell. Now, buy high and sell low is not an investment strategy. It's the exact opposite that is an investment strategy. And that's why, in our belief, that outsourcing that fund management to somebody who, let's be fair, it isn't their money, so it doesn't have that emotional attachment to it, will lead to more logical and rational decision making. So as you'll see on here, the point of maximum risk is at the top, but the point of maximum risk is usually where a lot of people want to invest. The point of maximum opportunity is at the bottom, but that's exactly the time where most people don't want to invest. So most of you will be aware of the mantra of be greedy when others are fearful and fearful when others are greedy. You can only buy at low prices if prices have gone lower in the first place. Now, over time, we say watch the tide, not the waves, but ultimately over time, markets go up. I think most of us would subscribe to the theory that markets and economies tend to grow over time, as has been proven over the last 50 odd years. Every single scenario in this chart was the biggest thing in the world at the time. And of course, you can see coronavirus on the right-hand side, which has done some significant short-term pain. But ultimately, over the long term, markets have continued as an overall trajectory upwards. And there's things on here like the banking crisis and 9/11 and the tech bubble and a couple of Gulf wars, things like that. And it's not to downplay what's going on at the moment. It's to take a look at the long-term picture, that most of the time people who are investing money are not investing money for the next 6 months. They're investing money for maybe 5, 10, 15, maybe even 20 years or more. And over time, markets and economies tend to grow. So when we start talking about the short term, you'll understand where I'm coming from with the view that markets tend to go up over time, given enough time to do so. This red line here is the same line you saw before, but the black line that looks like a lie detector test is the daily volatility of markets over on a daily basis over the last 30 years. And the thing to look at here is on the red line, the red line tends to do pretty well after periods of volatility. After the periods of volatility is usually when a lot of people have got out. So I guess what we're saying here is the biggest mistake that people tend to make is markets go down and then they crystallize that loss, raise risk at that point, and then get back in again when things have already gone up. That's exactly what we would advise against doing right now, because history states that that is not the way to achieve your long-term investment returns. This slide here, which I apologize for the size of it, it doesn't tend to come out well on Zoom in terms of how small it looks. On the left-hand side is your year of investment, and on the top line is your year of encashment. There's a lot of 10s, 11s, and 12s here, but the key point here is there are very few negatives. There's no negatives that are over 6 years on here. Now, that doesn't mean there's a guarantee of positive return over time. It's just that historically and statistically, you have more chance of a positive return the longer you hold. And actually, the more you get up to the top right of this chart, you do see that the returns don't tend to fluctuate a great deal. And of course, by that time, they've been through 6, 7, maybe even 8 market events such as this, all for different reasons, but all with the outcome of markets falling and then gaining again after that. On to the now. The US market has done pretty well, but we're in a scenario right now where the US market in particular is being driven by some quite big tech companies. So in this case, Microsoft, Apple, Amazon, Google, which is Alphabet, and Facebook make up 22% of the US market. Now, there's 500 stocks in that market. 5 of those stocks make up nearly a quarter. And therefore, of course, if those 5 stocks do well, then the US market looks like it's doing well. But our belief is that, you know, like I said about when things are high, people want to buy them. These are the things that we get more questions about at the moment than anything else. How much Microsoft have I got? Have I got Apple? Have I got Amazon, etc.? These things have never been more expensive. They've never done better. And historically, these things tend to reverse quite quickly, which I'll get onto on the slide after this one. Another thing to point out about how the market's shaping up right now is that I've put this in deliberately because we're doing this via Zoom right now. Zoom, which is a company that I'd love to gauge how many people had actually heard of it in January. You know, Zoom now is bigger as a company than the world's 7 biggest airlines combined. Well, given that we all assume that somewhere down the line we will all be let out of our houses and be able to work and meet people in face to face, etc., rather than having Zoom quizzes and Zoom meetings and, you know, Zoom family calls and things like that, you'd expect that this doesn't feel massively sustainable in terms of its size relative to airlines, which are priced as if we're never going to fly anywhere again. Now, I'm not saying we'll all suddenly go back to 3 flights a year, but even 1 flight a year would actually increase the revenues and the market holdings of those. So we're not saying there's opportunities here right now. There's none of our fund managers that actually hold airlines right now, but we would be amazed if that continued over the next couple of months. There will be a point at which the fund managers are willing to dip their toes in these short-term risks somewhere down the line. And the last slide, just to show how things have changed over the years and how buying high doesn't tend to lead to a good outcome. I'm going to go through various the last 4 decades one by one, and just show you what the top 10 companies in the world were at the end of each, at the start of each decade. Now, I'd love to see people's faces at this point, because you can always gauge people's ages by when they start nodding along with this. But in 1980, the oil price was at its all-time high, and huge oil companies pretty much ruled the roost. 40% of your money would have gone into these 10 companies at that point in time. And yet, I would ask you a question of how many of these do you think were in the top 10 by 1990? Just 2. By 1990, Japan had risen through the ranks. It made up 43% of the world's stock market, and therefore your top 10 companies would have been ruled by Japan. Now, if I tell you now that 7% of your money would now be in Japan, you will probably be able to work out how that 43% of your money would have done, because 10 years later, only 2 companies were still in the top 10 companies in the world in 2000. Now, 2000 is now what's known as the tech bubble, so full of technology companies and telecom companies and things like that, and media companies. 10 years later, post-tech bubble and post-banking crisis, just 3 of those were surviving in the top 10. And therefore, in 2010, China, Russia, India, and Brazil made up a huge amount or far larger now, then certainly Brazil and Russia did, than they do now. And if you ask yourself how many of these are in the top 10 companies in the world today, it's 2. It's the biggest 2, admittedly. But the way that I would look at this is, it's a fund manager's job to position your money for what 2030 looks like. It's not a fund manager's job to say to you, Amazon is doing really well today, let's put all of your money in Amazon, for example, or Google or Facebook. They may well carry on doing what they're doing for the time being, but history states, as on here, that investing in the top 10 companies in the world at their market weightings at that point does not historically produce a great outcome. That's us shaping our long-term view and the way we're looking to invest money. What I'm going to do is I'm going to stop sharing now, and hopefully Carla will be there to continue the Q&A section. Carla, are you there?
Okay, thank you, Darren. Yeah, hopefully that's working now. So now we've got some questions, Darren, for you, if that's okay. Thank you for that update. That was really interesting. I particularly like the last slide, which just shows how the top 10 companies can change over time. It's quite shocking, really. So I've kind of grouped the questions together. So if we look at questions which are more about what's happening in the world now, if that's okay. So the first question we've had is, what's needed to stabilise markets? And if a vaccine is found, will any positive reaction to the market last for a reasonable time period?
Crystal ball. Yeah, so I think a couple of angles on this. I think what's needed to stabilize markets. I don't think a vaccine is needed. I think that's not as controversial a statement as it sounds, but I think in terms of getting the economy going and getting people working, getting people going about daily life again, I've said probably for months now that it's not a vaccine that's the end goal here. It's probably an effective treatment. Now, an effective treatment that essentially eradicates, if we got to the point where it essentially eradicates the risk of death, then you take people's fear out of it. Because at the moment, if you genuinely said to people, how many of you would go to a pub, how many of you would go to a restaurant, how many of you would go to a football match, a concert, 80% of people wouldn't go, because there is that psychological, there's more than just I'm not allowed to go. There's a psychological barrier now. So I think what's needed to stabilize markets is probably the risk of death going to barely anything. Great news yesterday about the drug, which I haven't quite nailed the pronunciation of, so I won't go into that one. But it's, that's the first step, isn't it? I mean, so from what I read, it reduces the risk of death by those on a ventilator by a third, and it reduces the risk of those on oxygen by 20%. So it's a start, and it's there. They've got enough for a second wave, supposedly. So I think that's a starting point. I think a vaccination. I mean, I'm married to a biology teacher who tells me that the chance of a vaccination within 5 years is pretty remote. So therefore, she knows more than me, but not everything by any means. But that's just based on how long it takes to do this, and then to actually be able to distribute it to 70% of the world's population. That's a far bigger exercise than treatment, for example. So treatment was always more realistic. So at that point, you then get to, if people are working again, if people are functioning and spending money and going out for meals, the leisure industry comes back, cinemas, etc. All these airlines. Then actually you get to a point where that stabilizes markets. What destabilizes it is a second wave, or it feels like at the moment you're almost on this limbo point, and I do find it quite interesting. So if you take the FTSE 100 right now, which is roughly 6.3, the high was 7.7 and the low was 4.9. So you are slap bang in the middle, and that feels exactly where we should be based on what the second half of this year looks like. I can't see a point where it's a straight line from here. You either get an effective treatment and people gain confidence, and et cetera, and you get quite a decent bounce, or you get a second wave, in which case it falls again. Now, that is the whole point of diversification, and we're not trying to time the market. We don't know where it's going to go. All we can focus on is, over time, things tend to go up, but there will be short-term fluctuations along the way. And I'd probably also say that any recovery through history has had bumps in the road, should we say. There's never been it makes us chuckle when people talk about V-shaped recovery. It's never happened. So I'm not sure why it would happen here. It's always been a bumpy road upwards. But history, given enough time, will tell you that staying invested is usually it's the hardest thing to do, but it's the best thing to do.
Definitely time in the market rather than trying to time it, isn't it?
Spot on. Yeah, it's we've never met anyone who can time the market. So that's as far as we're concerned, no one does. And if they tell you they do, they're lying.
Thanks, Darren. This is a question that I've been asked quite a lot over the last couple of months. In the current environment, what are my fund managers doing differently that they weren't doing prior to COVID-19?
Working remotely. There's almost three parts to what the first half of the year looked like. So January, February, what were they doing? Well, the economy was going to carry on well. We may well get to Trump, but Trump was going to walk the US election in November. That things have changed there, or we may well go into that. But the economy was just going to carry on, and things were rosy, and everyone was happy. Everyone received their wealth accounts in January, and they were happy. Let's be fair. Fund managers were the same. It was a case of actually, if I said one of the most held stocks within our funds was Cineworld in January, rock solid as a company. If Disney released a Marvel film twice a year, Cineworld just hoovered up. It's just, so they didn't really have to do much apart from just keep putting on the service that they did. In the blink of an eye, everyone sold Cineworld, and they don't hold it anymore. So phase 2 was no airlines, no cinemas, no restaurant chains, no, it just got to the point where you can't hold any of that stuff, which is already the story of the second phase. And what that rotated to was almost the obvious things of food. It's interesting again today that more data came out about what people were spending money on during April and May. In the UK, clothing sales went down 35%, food sales went up 10%, and alcohol sales went up 31%. Now, alcohol sales to go up 31% in a period where pubs aren't open is quite astonishing. I'm sure there's some people on this call who are probably thinking to themselves, yeah, I probably contributed to that. It's funny, our recycling gets taken every 2 weeks. It's really not enough. But it just shows that spending habits change for that period of time. So I think what became very obvious was that you had to be exposed to things that people had no choice but to spend money on. So food, insurance. So everyone will have still paid their car insurance, but nobody's claimed anything. So those companies have done okay. Pharmaceuticals, people are still going to get ill, obviously. You have utilities. We all still have to pay our electric, our water, and our gas bill. And actually, because we're in the house, we're probably spending more. So there were all these things that, and obviously tech companies did pretty well out of it, because Zoom or I get 4 Amazon deliveries a day. No idea who's ordering it, but there's 4 people in this house who've got access to my account. So therefore, the doorbell rings all the time and there's something on the doorstep. Don't know what it is. But that's the way people have lived for a bit. Now, the next step is almost the unknown of what a fund manager is doing. Well, like I said, I think within a couple of months, airlines will be an opportunity. I think they're priced. In January, they were priced as if everyone was taking 3 flights a year. Now they're priced as if everyone is taking 0. Actually, they only need to open up again, i.e. not go out of business for them to be an opportunity. They don't have to get back to where they were if you buy in now. And I think it's very similar to the way banks were in 2009. Actually, they just needed to not go out of business, and they were an investment opportunity at that point. Dipping toes in, but there's decent opportunity there for some quite small holdings. And then you say that they've got restaurant chains and things like that. High street retail's got a long way to go. I don't think I'm not sure that that wasn't really a golden period for that kind of thing anyway. But it's really up to a fund manager to work out, well, actually, when things go back to the way they were, what are people going to be spending money on again? And I think you can get some quite interesting, just by driving around. I mean, you're seeing queues in McDonald's, you're seeing queues at Burger King, KFC. People are willing to wait an hour and a half in their car for these things. I'm guilty enough that I queued for 15 minutes at a drive-through Starbucks because I needed a vanilla latte. Very southern of me, I know, but it's I guess what I'm saying is, just because people have been locked down in their houses for 3 months doesn't mean that their habits have changed or their wants and needs have changed. And I think for a fund manager, it will be a case of come July, and July is the crucial one, because at the end of Q2, you'll have all the data for April to June. At the moment, there's a lot of guesswork attached to it. And guessing doesn't really, again, get a good outcome. It's heads or tails. But if you get the Q2 data, you can make more of an idea of, we know what the damage is, and we know what the solution will be, and we know who the winners and losers will be in that solution. So I think I can't really say to you what the winners will be right now, because we don't really know who the losers are. But there's some obvious ones of, look, we are going to go on holiday again at some point, and assume we're not going to sail there. Cruise ships are an interesting one. I can't see them recovering for decades. It's their target market. As one fund manager put it to us, they can't see a point at which 1,000 pensioners want to go on a floating petri dish, which I think is an interesting way of putting it. And actually, it's true. I mean, how do these things come back from that? So there will be winners and losers, but the idea that we don't go on holiday again is unlikely. So travel operators, restaurants, I'm craving just someone else cooking. I just, so it does feel that there are some opportunities there, because people haven't changed as much as I think the perception is that everyone's more than happy to work from home, and we're not ever going to mix with people. It's just not going to happen. It will be quicker than that. I mean, it's 3 months since I last had a meeting face to face on the 9th of March. I don't want to do this for another 3 months. Now, that's not to say I won't. I can if I will have to, but it feels that, even things like petrol. I haven't filled my car up since the 9th of March, but apparently it went down to less than £1 a litre. But no one bought it, so it can be as cheap as you want. But assuming we drive somewhere again, then you would think that we're driving somewhere to spend money. We're doing this, we're doing that. So people being active and being out and about generates revenue for someone. It's just identifying who. So that's what fund managers are doing differently. And in January it looked obvious, and now it really isn't.
Just following on from some of your comments there, question here: how many of our fund managers hold positions in airlines and hotels? And if they do, when is this sector expected to get back to pre-COVID days?
When we take 3 flights on average, the average person took on average 2 to 3 flights a year. So the only way they can get back to where they were was with 2 to 3 flights a year again. But I guess the point I would make on that is you don't need them to if you buy them now, or in the next few months. So that's only really, I think, where they were in January is only relevant if you held them in January and you've held them throughout. I think the beauty of active management is you can sell them at that point when it looks like there's not going to be a problem, and you can buy back in lower when there's more clarity on what the solution will be. So I think that the key to that will be, like I said, there's no airlines in there at the moment. There's no hotel chains that I'm aware of in there at the moment. But within 3 months, I'd be absolutely amazed, because there will be guidance as to how these things can function going forward. And at the moment, there isn't. And that's why fund managers won't touch it, is because until you know what the guidance is, you don't know what their revenues can be, because there's all the talk about middle seats. You can't have those anymore. So therefore, that's going to have a massive impact on revenues. But that's not official guidance. That's just speculation. So until there is the official guidance, fund managers won't fully commit. But they've always got their eye for a bargain, and which is what you want them to have. And it looks cheap, but just because it looks cheap doesn't mean it is. And it's waiting to. It's getting. We don't try and time the market, but a fund manager's job is to try and do that. Yeah.
Darren, a question that's just come in online now. I've noticed that the world stock markets have fluctuated quite violently in the last few months, typically plus or minus 200 points. Can you give any examples of what causes these major fluctuations?
More often than not, sentiment. What you get is, so what the market's been, so equity markets are what we call an anticipatory asset class. They generally reflect where the general consensus is that the economy is going. So for example, the market will reflect where the economy is in 6, 9, 12 months time, which is why it's often confusing why markets went up over the last couple of months when the economy is tanking. It's because it's already priced in that, which was the February sharp drop. So the February sharp drop was pricing in Q2 and Q3 being very tough. And what we're pricing in now is Q4 and Q1 being the recovery stage. Now, if that's wrong and there's a second wave, then of course that markets fall. That's why markets will fall, because it's not. But if those expectations are met, then the market goes nowhere. The market is only goes up or down on the back of either over delivery in terms of expectation, or under delivery, or the general consensus shifting. If the general consensus shifts, that might not take a lot actually, because especially if we're in this phase, if we've accepted that we're in this phase over the last couple of months, we don't know. Like I said, the eye of the storm, or we don't know, which means that you've got a lot of people watching the market. This doesn't apply to us, by the way, because we're more long-term investors. But the market, you've got more and more short-term investors. You've got people now who do nothing, but they're on their screens every day trading. They call themselves, their job is day traders. That they've just set themselves up to do this. They're trading numbers on a screen. And what we found over the last certainly 9-10 years is an increase. Technology leads a lot to this as well. That if something moves in the morning for no reason, which can happen, everyone else just reads into that everyone else knows something that they don't. So you see a small drop in the morning, which then over the day just falls and falls and falls because there's no reason for it other than people thinking, well, I don't want to get caught with this. And it's like a big game of pass the parcel, sell, 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 sell. It also works on the other side in that if somebody buys, if you get a big chunky buy in the morning and the market and the FTSE opened up 0.3, you see the scenario where throughout the day people are buying because they don't want to miss out on, it almost feels like people aren't doing their own research and they're just relying on the market movement and jumping on the back of whatever it's done to buy or sell. Again, that doesn't generally get a good outcome over time. But in volatile times, the market can be moved by nothing more than people thinking there's something going on that isn't, etc. The market has long since gone away from day by day infection numbers and things like that. So it isn't even that. It was in the early days. It isn't now. But actually, I mean, what the FTSE went up 2.5% yesterday, on the back of Boris Johnson suggesting that there's going to be a deal with the EU in July. So there can be valid news. We can debate whether that's valid news or whether that's just hope or ambition, but it's positive news nonetheless. And sterling went up by 1.5%. House builders went up, banks went up, insurance companies, all the things that went down after 2016 went up yesterday. So it's an obvious sign of what would happen if there was a deal with the EU, and the UK market would do quite well out of that. But in terms of what's moving it violently over the last couple of months, it's sentiment and people thinking there's something going on that there just isn't. But it's just something as long-term investors, unfortunately, you have to put up with, because over 10, 15, 20 years, it does iron it out, and it does smooth out the volatility that we're seeing day in, day out.
Okay, thank you, Darren. Next question. Within my portfolio, is there any merit in adjusting the balance between stock market funds which have suffered and increasing holdings of bonds which seem not to have suffered so much?
Diversification is key, whatever the scenario. If markets are volatile, or if markets aren't, or if they're going up or going down, your portfolio should be tailored towards your objective, your timescale, and your risk. I know it's a cliche to say that the only thing that should matter to you is your own objective, but it's true. Never take your eyes off what your end goal is, unless somebody said to us, "I want to take as much risk as possible." I can't see a point at which we'd say diversification doesn't make sense. You'll be having these conversations with investors as well, but I meet very few people who say I don't care about risk. Everyone wants all the return for no risk. Let's be fair. That isn't possible. So it's about getting the most return for the level of risk you're willing to tolerate. Bonds are over time a valid investment strategy. They deliver routinely, depending on the amount of risk you take. You can get mid-single digit returns in bonds, which forms the core of a portfolio that just ticks over. And I think we're in a scenario right now where if cash is delivering barely anything and gilt's 1%, things like that, it just feels that bonds are just as valid as they were. They're not the biggest opportunity in the world, but they're certainly not pointless. But they are a valid diversifier against equities, because I'm sure as we go through the questions, very much focus on equities, and equities get all the headlines, and equities are the sexy returns, but they're also the downturns, and so they're in the public eye, in probably more than they ever have been, but they're not the be all and end all when investment objectives are being met. It's that how can we, if somebody says to us, "I want to achieve 3 to 4%," for example, we're not just going to put them wholly in the stock market, because you don't have to. You don't have to take the level of risk. So it's about achieving the best return for the level of risk the objective in the lowest possible risk we can, but matching it to what the objective is. And that's always going to be the case, regardless of whether markets are up, down, shaky, whatever they do.
Okay. So looking to the future now, Darren, the markets have bounced back significantly, but appear to be overpriced considering the long road ahead and the likely drop in companies' earnings over the short to medium term. Adding to that, unemployment numbers are up, and there's reports that economies will go into recession. Is now a good time to invest cash?
I'll unpick that first bit. Markets just appear to be overvalued. They could be. I think It could be undervalued. It could be the biggest opportunity in the world, and it could be the worst mistake you could ever make. And probably in 10 years' time, I'll tell you what the answer to that is. So it's, is it a good time to invest? The answer is always, I'll tell you further down the line, because 2009 was a really good time to invest, but no one was saying that in March, when banks were on their knees. Now, the reason for that is because the basis for trying to work out what these things, whether these things are cheap or expensive or not, is price and earnings. I.e., is the price, how much of the price reflected in the earnings, etc. Companies don't know what their earnings are, so therefore it's really difficult to judge what a cheap price or an expensive price is, because if you're not getting any earnings guidance, and this is why by July we might have a greater idea of what's going on, is because all companies will have reported what Q2 looked like for them, i.e. how much they earned and what they're likely to earn. So it's really difficult at this point in time to say. It could be the cheapest. It could be that. My gut feel is there will be stocks and sectors that are really cheap, and there will be stocks and sectors that look crazy expensive. But again, at the moment, it's heads or tails. You just don't know. But is it a good time to invest? I mean, I think it's one of those questions. Is it a good time to invest cash? I'd probably flip that around and say it's a bad time to invest cash, to keep cash in the bank. Sorry, because it's 0.1% per annum in an inflationary environment, which is 5 times more than that. Is it a good time relative to what you can get in the bank? Yes. I think with the watch the tide, not the waves argument, what I would very much focus on is, if we agree with that theory that markets get back to where they were, then let's take the FTSE. It's 30%. That's 30% up from where we are now. So to get back to parity would mean 30% upside from today. Okay. The average recovery in markets after a fall of 30% is about 3.5 years. Okay, so even an average recovery rate, that's 30% in 3.5 years, which isn't what you're going to get in the bank.
No, absolutely.
The longest recovery in history is 9 years. So even with those, and I'm sure there would be a couple of people on this call who say this is going to change the world, this is going to be the longest recession in history, it's the longest recovery in history. Well, that's 10 years. So 30% over 10 years. Not going to get that in the bank. Okay, so I guess what I'm saying is, for you to get 30% in a cash account, it would take 300 years. So as long as there is a market or economic recovery within the next 3 centuries, you're probably, I know it's a really simplistic way of looking at it, and we can pick holes out of the methodology there, but ultimately it feels that cash has gone so low that it just isn't a worthwhile long-term asset. So is it a good time to invest cash? It looks it, but it's always with the caveat of it will be a bumpier road than putting it in the bank. But yeah, I think the time in the market argument is such that there's no argument against buying lower that I can come up with, as long as your risk tolerance is matched up to what you've got, and that's the idea of the diversification and the objective matching, etc.
Thanks, Darren. So, will all this lead to inflation longer term? What are your thoughts about mass unemployment globally, and what extra impact will this have on a recession term?
Inflation in the short term is going to be dictated by oil consumption. If you actually look at the inflation figures that came out today, food inflation, alcohol inflation was all about 1.5%, 2%. It was oil price fall and petrol consumption that drove it completely down. So you would think that as petrol consumption went up, that would find its way back to where it was before. In terms of employment is an interesting one, because that could drive inflation as well. Inflation to be higher would need people to be spending. Where unemployment's interesting is, I'm trying to be diplomatic here. Furloughing could just be deferred unemployment, and we don't know. I think it's very ambitious to think that all of those jobs will suddenly spring back, and I include us in that, as well as the US. I mean, the US have added 24. They erased 10 consecutive years of falling unemployment in 3 weeks. So within 3 weeks, a decade of growth was gone in terms of the employment market. Now, all of those people aren't going to get their jobs back. Most might, and for the economy, that most have to. But I think from the UK point of view, I'm not saying it's going to be as bad as that, but it's it's up in the air. So if unemployment rose, then people spend less money. So inflation probably isn't going to be as much of a problem. So for a healthy economy, you need the majority of those jobs to spring back into place. So it's inflation and unemployment will be linked, but again, that's before we even get into how the furloughing is going to be paid for and all of these other schemes that are going to be paid for. Well, the autumn budget in November will be very interesting to that. Might be worth doing another one of these at that point.
Yeah, absolutely.
Lots of talking points, but I think from a the global economy needs people working, needs people spending, and at the moment, I think it's highly ambitious that we get even close to where we were before, which will mean that there is a sharp uptick in recovery economically, and then the last bit is slower. So it's almost, people are obsessed with V's and W's and all this other stuff. The Nike tick is the best one I've heard of, where there's a sharp downturn, but then it's a slow recovery back up to where we were. But how long that takes, we don't know. But like I said, the longest recovery in history was 9 years. So no one wants to wait 9 years, but
Okay. Thanks, Darren. Just time for one last question. Do you have any thoughts on how the profile of the funds or other investment products might change in the light of perhaps a different world that we're going to be living in the near or medium term future? Perhaps regions, types of business, types of products, spread that have been a good bet until now and perhaps may decline, or things that were thought of as a good investment perhaps weren't, and how is St James's Place preparing for the future?
Yeah, I think it's probably worth bringing in here about the point about sustainable investments and low carbon and things like that, because it's something we've talked about quite a lot, and it was interesting to hear that you've already run a webinar on that, because our best performing fund last year was a sustainable responsible investment fund. It's only down 1% this year, which is quite an achievement given everything that's happened. Now, that isn't by design. We didn't say, right, look, we want an antivirus fund. This is just that when you've got a fund that looks so far ahead in terms of sustainable investment, and so even things like electric cars, clean energy, sustainable food production, water filtration, all of these things that this fund is investing in, that's not affected by what's going on today. And so I think what's quite interesting is that we've almost had a real life stress test scenario where the world is going through what is quite, let's be fair, is quite a developed market issue. There's issues with oil, there's issues with restaurants and hotels and airlines and things like that, that, let's be fair, they're the present. They're not necessarily the going forward, the long-term strategy. And so what I think was quite interesting is, that sustainable fund, or there's other funds that are quite technology heavy, that obviously technology will play a big part in in all of these things, especially electric cars and things like that. I think what's quite interesting is the level of protection that these things have shown lately. But in terms of how it's changed our view, I think our view was always the long term, that this was the way that things were going, particularly with the low carbon stuff. We just think that that's accelerated the trend that would probably have happened anyway, but people actually now have to think a bit differently, at least in the time being. Some things will stick, some won't. I have differing views on oil price and things like. I don't think a low oil price is a great thing for clean energy, because as long as it's cheaper for people to use oil, they'll use oil. But I don't think oil will stay. It's not going to be minus numbers. I know, and it didn't stay there for long. So I think again, when that will bounce back relatively quickly. So I think it's what we find interesting going forward is the sustainable side of stuff. But then most fund managers would say, well, I wouldn't invest in a company that wasn't sustainable anyway. So when we're asking fund, there are companies out there who are asking fund managers to produce almost month by month numbers. So they're worrying about them now. We're asking fund managers to generate returns over a rolling sort of 5-7 year cycle, which gives them a lot more freedom to be a bit more adventurous in the looking ahead space, or how the world is going to look like in 2030. We give them a lot more freedom to do that, and it does generate better returns because you're not obsessed with the here and now. You are looking at what the world will look like, and there's no doubt that the world will look different in 10 years time, particularly around the environmental stuff. the social stuff. We're engaging with all of our fund managers now. We're just about to say that we're not going to work with managers who aren't willing to sign up to the United Nations Principles of Responsible Investing. So all of our fund managers now have signed up to it. Some needed a bit more coaxing than others, but we've got them there. And we'll now make it public knowledge that we will not work with anyone who doesn't. And I think that's a huge step. So I think I get everyone will be obsessed with the health crisis, the economic issues, etc. But I think by adopting that more sustainable and responsible investment strategy and influencing managers to do so, I think you're going to generate better returns over the next 10 years, because that is the way the world will go. So let's be fair, there is an ethical side of it, but there's also, look, we're looking to generate returns as well. But actually, if you can do both, then I'm not sure we see a downside to that. So that's definitely going to be a theme over the next couple of years, if not much further on than that.
Brilliant. Well, thank you for that, Darren. I don't think we've had any questions come through. I found that really interesting. Thank you for the comprehensive answers. So I do hope that everybody else has enjoyed that. The next webinar that we're planning will be in a couple of weeks, and the topic is wills and trusts. So we're going to be joined by Michelle Tong from J&W Solicitors. So there should be an invite coming out very soon for that if it hasn't already done so. So do keep an eye out. Click on the link to register. And again, pass on to any family or friends that you think might benefit from it. And again, just to remind you that at Oakmere, it is business as usual. We're carrying out all the meetings by video or phone. All the paperwork can be done electronically. So do just get in touch with us if you've got any questions. We're all more than happy to chat to you if there's anything that's on your mind. And so finally, I just want to say thank you to Darren for giving us your time today. I know you're very, very busy. And thank you to you for attending. So please stay safe. Thank you.